Hey guys, how's it going? Today we'll cover inventories, ASPE 3031 and IAS 2. There's not much significant difference between these two standards, so let's get at it. So we'll cover two phases. First is, well, what the heck is inventory? How do we recognize inventory? And then the second phase is, once we do recognize inventory, how do we record it? So first, what is inventory? Inventory is a physical asset that is generally for sales or consumption. So what is an asset? There's 3 points that identifies an asset. First is we control the resource and we control the access to the benefits. Second is will this resource generate economic benefits for us? And then third is, can the cost and the value of this resource be reliably measured? And to be more specific, the 3 points are inventory is held for sale in the ordinary course of business. It's in the process of production for the purpose of selling. And then third, it's in the form of materials or supplies to be consumed in the production process or when we render services. So the issue with inventory is, do we record it at the full amount? Do we record it for a lesser amount? Or we record it at zero? The triggers of when to recognize an inventory issue is, let's say there are returned goods, there's damaged inventory, outdated inventory, or when the inventory is banned because of government regulations or laws that came into effect. So once we do classify and recognize inventory, how do we record it? So under ASPE 3031 and IAS 2, inventory must be measured at the lower of cost or net realizable value. So what the heck is cost? Cost is just what we have it recorded on our books. Net realizable value is what the customer or the market is willing to pay for it. The formula for that is proceeds minus selling cost. If the inventory cannot be sold or used, the NRV will be reduced to zero. So what? So let's say if there was an inventory write-down, this would have a negative impact both to the income statement and the balance sheet. The reason why is because there's a decrease in net income because the inventory write-down is considered a loss, and then there's a decrease in current assets because our inventory value on the balance sheet has went down. The general journal entry for this would be debit inventory write-down loss and then credit inventory.